Let's wrap up the trading week. Live from New York City this morning. Good morning, good morning. Your equity market bouncing back. The S&P 500 up 0.5%. The Nasdaq up by 0.7. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, tech earnings disrupt the Nasdaq's big rally. Strong U.S. data putting a Fed pause on ice as the BOJ remains committed to easy money. We begin with the big issue, a summer sweet spot.
Now we're in the sweet spot.
The bears are like melting in the hot summer sun.
Strengthen the fundamentals
really help spur this risk-on rally.
Growth is held up very well.
We've had massive positive growth surprises.
It's really a celebration of disinflation.
Inflation's coming down.
The Fed is, seems comfortable hiking slower.
The prospect of a recession has trended lower.
Maybe we won't have that recession. It's status quo for now.
It's right to think about sort of what comes next.
We're a few percent overvalued.
The risk is that inflation kind of goes back up.
September, October are treacherous months for the markets.
We're not out of the woods by a long shot.
Let's have that conversation right now with the brilliant PIMCO's Andrew Balls. Andrew, wonderful to catch up, sir, as always. Investors worldwide at the moment seem to be embracing the idea of a soft landing. Do you and the team still see a recession stateside?
So we think the most likely outcome is a recession, but there has been promising signs in the data. So you could certainly have a slowdown, but without the formal recession. I mean, the interesting thing is we think that you're going to have to see slower growth and some greater weakness in terms of the labour market in order to get inflation coming down next year. Towards the Fed target. So still our expectation of the rise in unemployment and the kind of magnitude which would normally be associated with having a recession, yeah.
We seem to be in this sweet spot at the moment where inflationary trends start to look disinflationary, where unemployment remains low at 3.5%, payrolls growth remains decent. Do you think that sweet spot can last beyond the next couple of months?
I mean, I think yes. I mean, I think the decline in terms of inflation is promising in the US. Hopefully, it's a leading indicator for Europe, where we're a little bit behind. But there's not a lot of indication yet of greater labour market weakness. But we do think you have the lagged impact over the next few quarters of all the tightening we've seen, and it's been very, very rapid rate cycle from the Fed. We think that the impact of tied to credit conditions from the regional banks in the US play into this as well. So yeah, more likely than not that you have a recession over the next few quarters.
Let's turn to the Federal Reserve. In your secular outlook in the last couple of months, Andrew, you and the team mentioned that this Fed would tolerate 2 point something. Can you tell me the difference between 2 and 2 point something? How big is that difference?
So I think, and it's something that my colleague Rich Clarida has talked about a lot, for the Fed to think about easing policy rates over the next year and a half, they're going to need to see inflation coming down from where we are now. And once you get to 2 point something, I mean, at that point you can start to think about rate cuts over time. And there's a question, an uncertainty about quite how the time frame for getting from 3 something down towards 2.0. And this may be something where the Fed is willing to be a little bit patient. But once you get down below 3%, that's near enough, we think, for the central bank that they'll be then thinking about the other side of the dual mandate as well. This recent period, clearly the focus has been wholly on inflation, just given where we have been.
Are you making the argument, Andrew, that maybe the window for cutting might be closer than people anticipate?
I don't have any big disagreement with the way the market's pricing. I think the time frame for next year looks reasonable. I think there's two big sets of risks around the baseline outlook. One is inflation stickiness. The other one on the other side is greater than expected weakness in the economy. And I think over time, as you get more confidence in terms of the inflation outlook, including getting below 3%, then clearly the focus for the Fed, I think also the focus for markets will be more on the growth risks to the equation. So I don't have any particular disagreement with the way that the market is pricing now, but as you get more data, if you do get better indications on the inflation side, then I think the growth risks will come to be clearer in focus.
Can we push that through the bond market currently with the 10-year at 382? Are you and the team saying that's a buy here?
So I think that the level of yields looks pretty attractive for the next few years. I think the outlook in terms of returns looks very attractive for high quality bonds, and if you look at the yields you're getting on high quality bond funds, and then compare that to expected equity market returns, and I think it looks very attractive. And then the second thing is, with policy rates at these levels, we've just been talking about the potential for Fed rate cuts over time. You do have that real room for policy easing, and that room for bond portfolios to provide a diversification versus equities in your overall asset allocation. So I think the level of yields in the US looks attractive. At PIMCO, we've been generally adding a bit more duration in our portfolios over time.
Andrew, where does that leave the shape of the yield curve? Because currently the 2-year versus 10-year is negative 101. That's deeply inverted on a historical basis. How are you anticipating that's going to evolve in the months and quarters ahead of us, given what you anticipate is going to happen with growth?
Yeah, so I think it's been a long period of inversion off the back of this inflation shock. We've had this policy rate shock. I think over time, and if you look into into forward rates, you see the normalization of the curve over time as the Fed is able to cut rates over time. So in our portfolios, over time, I think we will have a bias to have curve steepening positions in the portfolios, but I don't think there's any great rush to put that on myself, because we very clear indication that the Federal Reserve will hike rates next week, and they may well go again after that.
So that's the Treasury market and the prospect of a downturn in economic growth. We need to turn to credit as well. High yield spreads, Andrew, are so tight, near the tights of the year currently at about 380 basis points. I just wonder whether you're anticipating a pickup in defaults, if you're looking for a downturn in growth, and how you'd be positioned in credit currently.
So back to the kind of the outlook, the baseline of the possibility of a soft landing, probably more likely a shallow recession. I don't think that has to be too problematic for credit in that baseline if we get there. The problem is the risk cases around this. If there's inflation stickiness, if the Fed is forced to go more, I think that could be quite disruptive for risk assets and high yield. And in a downside growth case, if the impact of the Fed tightening is more than we markets, PIMCO, or the consensus is pricing in, I think that's problematic for credit as well. So given the tightness of credit, I think it makes sense to be a little bit underweight here. And there's other alternatives. There's other ways of earning spread without that exposure to corporate credit. I think agency mortgages look quite attractive in the US, and I think more broadly there's a set of mortgage-related securities you can buy in the US and globally that look attractive. So I think that's offering better risk reward at the moment compared with corporate credit. And then back to the level of 10-year yields for treasuries and the yields on high quality bond portfolios. I think sticking with IG, sticking with investment grade credit, seems perfectly sensible here. You don't need to go down in quality or liquidity, I'd say, because the yields you can get with high quality bonds now are really, really quite attractive.
The focus, as you know, this morning, not just on the Fed next week, not just on the ECB, but also on the BOJ. We're reporting that the BOJ isn't going to move away from yield curve control anytime soon. Andrew, if we did get a reset of policy at the BOJ, and forgive me for the what if, but I am trying to work out what the scenario analysis might be from a place like PIMCO. If you back away at the BOJ, how are you thinking that spills over the European bond market, spills into treasuries? Is it just a wholesale drop of bonds abroad and Japanese investors return home? Like, what happens if the BOJ backs off?
So I think there's a range of outcomes. If you want to start an argument at PIMCO, this is a pretty good topic. So there's some of us, and I would be in this camp, that think that the BOJ move is very well telegraphed over time. It's expected that they will move away from yield curve control over time. And compared with the rate shocks we've seen in terms of the Federal Reserve, the European Central Bank, et cetera, it's hard to see why this should be such a big impact in terms of global markets. There's another camp, though, and this is often people who are working on the hedge fund side of the equation, where real sensitivity to spillover effects from the BOJ move. So I think we'll see how this plays out over time. My view, and if you look at the move in December, when they started this process, there were no big impacts in terms of global financial markets. So my expectation is something that's well expected, should not have too big an impact. And then with JGBs, I mean, we are probably at a somewhat artificial level here. You would expect yields to be a bit higher. You see this with the swap market if they were to move away from YCC. But I don't think we'd expect very, very significant moves. And yes, as a Japanese investor, when you're based in yen in particular, I think over time you'll want to see Japanese institutions owning more. Being a bit closer to home. But again, the interest rate shock we've seen, the levels of yields available, say on European assets, I think for the market to absorb any shift from the Japanese investor base away from Europe, say, I don't imagine this would be something that would be too difficult to be absorbed.
Andrew Balls, thank you, sir, for the outlook on the Fed of fixed income, the BOJ at the end there too, the PIMCO Global Fixed Income CIO. Triple header next week, BOJ, ECB, Federal Reserve, all coming up. Let's get to Mike McKee on that. Morning, Mike.
Good morning, John. Well, call those the three faces of risk, maybe, because it's not going to be what the central banks decide that moves markets. It's what those leaders are going to say about their future policy. Take a look at what's expected. You've got a 95% chance of a Fed rate move, a 96% chance of an ECB move, and less than a 10% chance of a Japanese move, even though we have the Bloomberg story out today suggesting they'll talk about yield curve control. Look at the September numbers. Much lower, and in Japan there's actually a negative chance for a rate move. Here's why. The economies in these countries are cooperating with their central banks for the most part. We have new surveys out of economists across the world, and in the CPI inflation area, it's progress. Everywhere you look, quarter by quarter, inflation is expected to drop. Now, that's a problem for Japan, which may keep them sidelined longer, but for the United States and the Eurozone, it is what the Fed and ECB want to see. Unemployment also seen as moving in the directions that the banks don't necessarily want, but they've predicted higher in the United States, higher in the Eurozone, but no change in Japan. So Japan likely sidelined, but the real questions for investors are what comes next. As I mentioned, the Fed, they want to clarify the outlook. The ECB, convince the markets there's no cuts ahead, and the Japanese talk about yield curve control, but don't do anything about it yet.
Mike McKee, looking forward to that triple header. Much more from Mike through the week next week. Let's get you some movers going into the Open. Here's Abby.
Well, we're looking at a strong rebound for the futures after yesterday's sell-off. Let's take a look at one stock that is weighing and then what is working. American Express, these shares are lower after the credit card company missed revenue and adjusted earnings estimates as card spending slows, a possible sign of a consumer weakening, growing tired or even weakening. Tesla, after yesterday's big almost 10% drop on reduced profitability in the quarter that was and the future potentially, we have a little bit of a rebound helping out both the Nasdaq 100 and the S&P 500 futures up 1.4%. Pushing it forward to next week, well, Meta reports on Wednesday. That stock, John, up more than 150% on the year. Will their growth estimates of 8% on top, 23% on bottom, will they need it? Talk about AI. It's going to be interesting to see whether or not investors think that this big run-up has been justified.
Abby, thank you. Coming up, tech earnings briefly interrupting the tech rally.
Tech has tripped. One of our big questions coming into this reporting season is that earnings enthusiasm around growth going to fade a little bit and improve on the value side, and could that facilitate a leadership shift in the market?
Tech bouncing back this morning from one of its worst days of the year. Alphabet, Meta, Microsoft gearing up for earnings. That conversation up next with JP Morgan's Elise Ossenbar.
Since late May, mega cap growth in tech and the rest of the S&P 500 have basically been moving in tandem. So, the rally has basically widened out, but I would, keep that neutral rating basically on mega cap growth in tech. It's not a negative fundamental view. It's just a question of what's already basically in the price.
Disappointing results from Netflix and Tesla interrupting the monster rally in tech stocks this year. The Nasdaq 100 coming off its biggest day of declines in 5 months, fueling fresh concerns ahead of another busy week of earnings from Microsoft, Alphabet and Amazon, all on deck. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, big tech definitely stumbling out the gate a little bit when it comes to the earnings picture. You had Tesla down nearly 10% yesterday, while Netflix was down by more than 8%. You add that together, the Nasdaq 100 plunged 2.3%, as you say, the worst showing since February. And of course, the big tech benchmark, it's still over 41% higher in 2023. But that rally is really built on 7 stocks, and that 7-stock rally is really built on optimism over AI, which brings this warning from chipmaker TSMC into focus. The company said that the surge in demand that they've seen for AI, it's not enough to offset a global macroeconomic slowdown. So we'll find out if that's a TSMC specific view or a sector-wide issue when the likes of Microsoft and Meta take the stage next week, a week in which more than 25 trillion worth of market cap is due to report their results. Though I will note right now, the Nasdaq 100 futures solidly higher this morning.
Big week for earnings just around the corner. Katie, thank you. JP Morgan's Elise Ossenbar seeing plenty of opportunities outside of big tech. Earnings season could be a catalyst for broadening out the rally. She says we recommend more exposure to cyclicals and looking beyond the magnificent 7 big cap tech names. I'm pleased to say Elise joins us now for more. Elise, wonderful to hear from you because you've been constructive and right through 2023. Correct to be constructive on this equity market. Tell me why you think we can make new highs.
Look, our base case does have us trading about sideways between now and 1 year from now. But that bull case is really starting to get more attention amongst investors, because if we zoom out and think about how things have shifted, especially since the spring, the setup is looking more favorable. The soft landing scenario is definitely being discussed a lot as inflation comes down and the Fed likely gets closer to a place where they can pause. You haven't seen bank stresses kind of boil over to the degree that people might have feared, with deposit balances, staying steady for the large banks and actually increasing for some of those smaller regional banks. And earnings have this momentum, and we think are probably troughing right about now with potential upside in the future. So having a lot of conversations with investors about rebuilding those equity portfolios that they can carry not just through a potential recession, but into that cycle ahead.
And potentially rebalancing away from tech. So let's dig into that and talk about the earnings we've had so far. D.R. Horton came out yesterday. Here's an example. Home builder in America, decent numbers, upside surprise, ended the session lower. Elisa, what are you learning? Early days, I know, Elise, but what are you learning so far from how the market is responding to the earnings that are coming in?
Look, I think the market hadn't yet fully appreciated the potential for earnings overall to surprise to the upside. When we kind of pick apart the different sectors, we do think that this earnings season could be a catalyst for a broadening out of this rally. I think there's a lot of anticipation and good news already priced into the mega cap names. And when we start thinking about what's kind of going on with the cyclical economy, given the consumer resilience we've seen in particular, it suggests that there are opportunities elsewhere. So seeing a lot of traction with investors, looking at things like the equal weighted S&P 500 and adding exposure there via things like structured notes.
So that's the index. Let's get beneath the index and go sector to sector. At least discretionary has been huge this year. I talk about the airlines every day at the moment. The cruise line operators, they've boomed. That trade's done. Some people think it's already done. It's over. Are you still looking for those to make a move? Are you looking elsewhere? What are the parts of the market that have lagged that you think can pick up?
Sure. I like kind of thinking about longer term investment opportunities versus shorter term investment opportunities. So long term, very excited about some of those trends related to things like artificial intelligence, but also, the potential for more infrastructure spending. Don't forget that we have over $2 trillion worth of infrastructure spending earmarked for the next 10 years. So we think that that could continue to be a boon for industrials. Near term, we're starting to do some of the work on sectors that have been relatively unloved recently. Think energy, given the amount of negative earnings revisions we've been seeing there, and also the beat up in valuations that the sector has kind of experienced.
You're not alone. Looking for this rally to broaden out, to rebalance away from big tech. Elise, you were constructive and you were right so far this year. Elise Ossenbar looking for a whole lot more from this equity market, potentially more highs and that shift away from the market cap weighted S&P over towards the equal weight. We've heard that a lot on this program, haven't we, over the last couple of weeks. Equity futures right now on the S&P 500, they are positive by 0.5%. They are up on the Nasdaq as well. The next week, we've gone through the earnings calendar for you. Alphabet, Microsoft next Tuesday, Meta on Wednesday, Amazon on Thursday. The following Thursday, you're going to hear from Apple. Coming up on this program, the morning calls, and later, Keith Lerner of Truist makes the case for not chasing this equity market rally. That conversation about 7 minutes away. Minutes away from the opening bell. Equities up here, a lift on the S&P 500, positive by 0.5%. The Nasdaq, worst day since February yesterday, bouncing back on the Nasdaq 100 by 0.7%. That's the price action. Let's get you some morning calls. Deutsche Bank downgrading Sirius Radio to sell from a buy, saying recent gains are being driven by technicals and unusually high short interest. That stock is down 10%. Next up, D.A. Davidson upgrading Harley-Davidson to buy, expecting the company to top increasingly low earnings estimates going into next week. Their stock is up by almost 4% in early trading to $37.95. And finally, Piper Sandler downgrading Carvana to neutral, seeing limited upside after a monster rally earlier this week, popping 20% on quarterly results and a debt restructuring. That stock is up by 0.6% this morning to about $47 a share. Coming up on this program, Wall Street keeps chasing the rally as stocks continue topping year-end projections. That conversation up next with Keith Lerner of Truist. Your opening bell just around the corner. I did not get the pink memo this morning. TK did. Pink bow tie, leopard print shoes, should have seen it. Brutal. Equity futures right now on the S&P 500, positive 0.4%, up on the session, up on the week. The Nasdaq yesterday struggling. Netflix, Tesla taking a bite out of the rally so far year to date. Just a small one. Biggest one-day drop going back to February on the Nasdaq. A lift into the opening bell. There's the opening bell. Switch at the board and get to the bond market. Yields look like this on Treasuries, down 3 basis points on a 10-year to 3.82. Yields up yesterday off the back of a downside surprise on jobless claims. In the FX market, heading for the biggest weekly loss going back to May on the euro against the dollar. Having a look at 113 earlier in the week and now backing away to 111.30, unchanged on the session. Crude up by 0.8%. WTI $76.30. We're up there by about 65 cents on the session so far. In the session at the moment, about 30 seconds in, we are positive by 1/3% on the S&P. On the Nasdaq, we're up by about 0.6%. One mover to take a look at, American Express. Shares under pressure after delivering disappointing revenue numbers. The CFO saying spending levels are, quote, more stable now following the post-pandemic boom. Abby has more. Morning, Abby.
Good morning, John. And lots of nuance here to this American Express quarter. And the stock is down just moments ago, the worst day in more than 2 months. Now, I misspoke earlier. They actually beat earnings relative to consensus. It was the BI estimate that they missed, and that's on increased expense or lower expenses than expected. But revenue, yes, it's interesting. They missed the growth estimates. But what makes it so nuanced, they actually put up record volumes of $426.6 billion. But that missed the estimate, so you know how it goes. Investors are a little bit disappointed. But the company talking about the idea that despite this, I would think that this would maybe point to some kind of consumer spending slowdown. They're not saying that at all, that the consumer spending is still, quote unquote, really strong. So it's going to be interesting to see how this stock plays out. Again, lots of mixed messages here. Right now, the stock is down 3.7%, down closer to 4%. So the bears are taking it at this moment, John.
Abby, thank you. Allow me to draw your attention just to a headline, just quickly. The former President Donald Trump, the classified documents trial has been set. The date has been set for May 20th, 2024. What we're going to do now is get Anne-Marie down in Washington, D.C. When she gets to the camera, we'll have a chat to her about that. But that's the headline that's just come across, that the classified documents trial for the former president, the date has been set for May 20th, 2024. AMH coming up very shortly. Allow me to turn to the financials. The regional banks this morning, more earnings results coming from Regions Financial and Comerica, both seeing jumps in net interest income despite concerns about credit contractions. Let's get to Shanali for more. Hey, Shanali.
John, if you take a look at this week, the regionals are really coming out clean, pretty much. You're seeing deposit pressure still at the banks, but you do have net interest income coming in pretty strong here, jumps from a year ago and above expectations. Now, that's not across every bank, but it's certainly across these two regions and Comerica. Also for these two banks, that is even including pressure on net interest margins, a little bit below expectations in some regards. But importantly, provisions for loan losses have been better than what Wall Street estimated. So that means that they're both making money and credit standards are still holding up. Now, the hope is that this follows through the season, but the KBW Bank Index certainly has had quite the rise this week with a lot of these fears easing. Some analysts take Mike Mayo feeling like the worst is certainly behind us. Though profitability pressures still exist, it's nothing to cry home about after the sell-offs we've seen this year.
3 months ago feels like a lifetime ago, and I guess that's good news for many of these banks. Shanali, thank you. Let's stick with the earnings. CSX shares falling after the rail freight company reported Q2 revenue that missed estimates. The CEO writing this, activity remains challenged. Katie Greifeld has more. Hey, Katie.
Hey, John. Yeah, CSX shares currently off more than 5% after those results. So let's get specific here. EPS came in at 49 cents, which was actually in line with estimates, but you had revenue and operating income come in lighter than expected. Now, the company said that it was lower fuel and coal prices combined with weaker shipping volumes that dragged sales lower. And like you said, the CEO himself saying that this activity is going to remain challenged. So Wall Street was actually fairly downbeat on these results. You had Citi and Susquehanna, both of those banks, cutting their price targets on CSX. And Citi in particular still has a buy rating on CSX, but it said that these results are, quote, they did not live up to expectations and that the volume outlook remains uncertain. And once again, you can see that in the shares this morning, currently off by more than 4%.
Katie, thank you. Katie mentioning a couple of houses, banks, brokers with some views on this name. Here's another one on CSX and the rails. Morgan Stanley warning the markets could overreact to its modest earnings miss. Here's the quote. CSX was expected to be the only rail that could beat this quarter, so the miss may really disappoint. Let's go from the railroads to the autos. AutoNation topping earnings estimates. The CEO saying the strong performance during the quarter reflects the continued resiliency of our operations and the benefits of our diversified model. Simone Foxman has more. Hey, Simone.
Hey, John. Yeah, shares up, down all around in pre-market trading, but settling decidedly lower, down nearly 6% in trading this morning. This despite the fact that it did beat adjusted earnings per share pretty handily, $6.29 a share, topping the $5.89 that analysts had expected. But this was 20 cents lower in terms of earnings than last year. We're seeing a decided shift towards newer cars. This as used car sales falling, new vehicle revenue growth up 12%. So it's still making money, even though car values are a little bit lower. But we're clearly coming back to earth after that excitement during the pandemic. You know, one cause for caution here, and maybe why we're getting a little bit more negative response in the market today, is the gross profit on those new vehicles, falling under $5,000 per vehicle for the first time since Q3 2021. Used car profit also falling. That said, on the positive side, shares up more than 50% so far this year. So maybe just an end to that rally today.
Stock is down 5.6%. Simone, thanks for that. The latest there on Auto Nation. The broader market at the moment positive by 0.4% on the S&P. On the Nasdaq up by 0.75% currently after a big first half of gains. Stifel's Barry Bannister expecting the equity market rally to start stalling out.
Everything is a rental now. Everything is a trade. If you think back to 2022, utilities, energy, they were great. Then they were terrible in the first half. Tech was terrible last year. This year it was great in the first half. The cyclicals, the banks, they were terrible in the first half. Now they're going to be good. You really can't get too far ahead of yourself and over your skis when you're investing in this kind of a market. I think we're a few percent overvalued. I do think we end the year around 4,400 on the S&P 500.
Bannister reiterating Stifel's 4,400 price target for the S&P this year. This coming as Wall Street continues chasing the rally, with roughly half the survey strategists raising their year-end forecasts already this year. Keith Lerner joins us now for more. Keith, you can feel it. People starting to chase it. What are you advising your clients should do?
Yeah, well, great to be with you, John. So what we did actually, we came into the year a bit more on the defensive side. When we broke above 4,200, we upgraded our view on equities to neutral. We also did it back in early June in the equal weight S&P. I know you just talked about it. It seems like everyone's talking about the equal weight S&P, the average stock, which has lagged. We still think there's a little bit more juice in that overall trade. But from a big picture right now, we're strongly neutral, right? Strongly neutral against stocks, bonds, and cash. There's a lot of cross currents. This post-pandemic cycle is challenging the traditional playbook, and we're respecting the underlying trend. We don't think this is a runaway bull market. You know how you have a forward PE around 19.6, and we're going to hear from the three central banks next week as well.
Keith, I'm with you. This is so hard to read. I was reading your note, and you're dead on. Mortgage rates are at something like 7%, and the home builders have ripped all year. Makes sense of that. Manufacturing's in recession, unemployment's still at 3.5% because services are robust and discretionary spending through the roof on things like airfares and taking cruises. Keith, how on earth do you make sense of where we are currently?
Well, I think because this post-pandemic period, I think that the stimulus, which is still, coming through with the infrastructure bill, the CHIPS bill, has been underestimated. As much as how big it was, people thought it was done and there's no lingering impact. I think that fiscal impulse has been stronger. And I think on the other side, Jonathan, a year ago, if you and I were talking and we said the Fed funds was going to go from 0 to 5%, you said, Keith, what do you think about the economy? I don't think we would be arguing whether we would be in recession. We would be saying how deep. And what's been the biggest surprise is how resilient the economy has been. And the economy has been somewhat less interest rate sensitive, partly because of those locked in mortgages, partly because of corporations have termed out debt. But, that's the surprise. So I think at this point, you have these cross currents. I don't think this is a fat pitch as far as where the market is. A lot of the gains recently is repositioning. So I think you stay close to your long-term targets and be more patient to go either on defense or offense, later on in the year. But just right now, I think somewhere in the middle makes sense based on those cross currents.
And Keith, you're right. 12 months ago, it wasn't about whether we'd have a recession. It was about how deep it might be. You know what the conversation at the start of the year sounded like when equities started to rip and tech started to dominate? It was just bear market rally, bear market rally. And here we are 6 months later, 7 months later, and I still hear some people saying this is a bear market rally. Keith, who's to say this isn't the start of a runaway bull market like 09, like 20? Why isn't it that?
Yeah, listen, it could be, but I think our base case is it's not. And I'll tell you why, Jonathan. So when I think about the beginning of big bull markets, you have one depressed sentiment. So I think we can agree that sentiment was very depressed coming into this year and over at those October lows. You also bottomed last October when inflation, had spiked to the highest level in decades. So that's great. But, starting valuations today at 19.6 multiple for the S&P, that's the highest valuation outside of that pandemic overshoot that we've seen for the last 20 or 30 years. So starting points are much higher. And then what's really important is that policy from the fiscal and monetary side going forward will be constrained. What tends to really support those big, long, sustainable markets is liquidity coming into the market. Jonathan, I don't see liquidity coming into this market in any big way, in the near term or even over the next year.
A week ago on this program, Mohamed El-Erian turned around and he said, this is a soft landing narrative that you do not want to fight. I've heard others say we're in this sweet spot that could last a few weeks, last a number of months. Keith, do you not subscribe to that at all, that the data over the next couple of months is going to support this idea? Whether it happens or not, people will believe it because we're going to see more disinflation, more robust labour market prints, and people will get on board with this soft landing theme.
Well, I think that's probably already what we've been seeing. That's one of the reasons why we upgraded equities, seeing that the positioning was offsides, which already is starting to be covered, and we're going to see disinflationary trends in the summer months as well. And again, the market was caught offsides. As we get into the fall, I think as you think about base effects on inflation, maybe we get a little bit more stickier there and it becomes a little bit more problematic. And also as you move in a little later in August and September, historically, that's when the volatility index starts to move up. And there's probably something that 3 months from now, Jonathan, that we don't know that's coming. We're going to be talking about that will change the narrative as well. So listen, at this point, we're respecting the underlying trend. We moved our equities within equities. We're staying with the U.S. We're still Team USA. We're focused on large cap. And I would also say we see some value here in the 10-year, at 3.8%, even a little bit longer duration, just to hedge portfolios to some of these cross currents that I've talked about.
Andrew Balls of PIMCO said the same thing 40 minutes ago. Keith, one more question, then I've got to get to my colleague down in Washington, D.C. But if you had a pick right now, if I could give you something up front, would it be the Fed decision and news conference with Chairman Powell or tech earnings and those results next week?
I will say tech earnings. Tech earnings are important. I mean, you look at the market this year, the technology sector's up over 40%. We all know the story about how much they've driven the gains. So tech earnings are going to be, very important as far as holding up this market and what's happening next. Our baseline view, though, we upgraded tech in March. We think we're in a resting period. We still think tech is leadership. I don't have a big call about this earnings season per se, but if the economy does slow down later in the year, as we expect, I think companies are going to have to continue to invest in technology regardless, and that should support better earnings from tech relative to the broader market.
OK. Keith, thank you, sir. Keith Lerner there of Truist. Your equity market at the moment positive on the S&P. Some breaking news just moments ago. Let's get down to Washington and catch up with Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John, we now have the date for the trial of former President Donald Trump related to that classified documents case for which he is facing 37 counts of 7 different federal charges that he, of course, has pleaded not guilty to. May 20th, 2024. And in theory, John, this is probably not great news for either the defense or the prosecution. Prosecutors at the Justice Department had wanted to try this case this coming December, while former President Trump had bid for it to happen after the 2024 election because, of course, he is seeking the Republican nomination, which makes this timing, John, incredibly interesting because in May 2024, we will be post the Republican presidential primaries, but before the convention that is taking place in the summer. So potentially a very politically sensitive time for the former president. And he could be dealing with a number of other legal challenges at that time as well. As we know, he hasn't just faced this federal indictment. He already was indicted in New York on state charges. Earlier this spring, he could be facing down another potential federal indictment from Jack Smith, the special prosecutor who brought this case. President Trump himself said he received a letter from Jack Smith just days ago saying that he is a target of an investigation related to January 6th and efforts to overturn the 2020 election. He is also facing potentially an indictment in August in Fulton County, Georgia, also related to the 2020 election. So the litany of legal challenges really stacking up for the former president. And again, he will be going to trial in Florida on May 20th of next year, John.
Katie, thank you. It's on the calendar in bright red. There we go. That headline just crossing. Kelly Lyons, May 20th, 2024. We'll turn to that a little bit later on Bloomberg TV and on Bloomberg Radio. Balance of Power later on this evening, 5 p.m. Eastern Time with Katie, Anne-Marie and Joe Matthew. Coming up, preparing for another big week of tech earnings and for big tech and the Nasdaq's rebalancing.
Some of these names are in the Magnificent Seven, and they were easy to jump onto when the market was going up straight almost for 3 months in a row. The healthiest thing would be that if money started to flow into other areas of the market and broaden.
That conversation coming up next.
Earnings
earnings the next couple of weeks are going to be so important, right? These companies' valuation is expanded, sentiment's quite high, and not only do they need to hit their numbers, they really need to satisfy the sentiment, right? And they need to keep the animal spirits going in those stocks. So you could have a situation where they nail the number, and the guidance or the discussion around AI, for instance, isn't quite as exciting as people would hope for, and the stock could come under pressure.
Big tech bracing for the Nasdaq special rebalancing. Chris Harvey of Wells Fargo writing, quote, "The upcoming rebalancing is reducing concentration risk but creating uber cap selling pressure, with near-term liquidity demands likely weighing on the group." Let's get to the team coverage. Katie Greifeld and Mandeep Singh join us now for more. Katie, first to you. Talk to me about this rebalancing and what to expect over the next couple of days.
Well, it's special. It's out of cycle. And of course, this is designed to reduce the weight of those top 7 stocks in the Nasdaq 100 from a current combined weight of 55% to just under 44%. And it's scheduled to take place today in anticipation of Monday's opening. But today, in addition to it being a special rebalance, it's also option expiry day. So just to complicate matters further, we have about $2.4 trillion worth of options set to mature today. So usually that introduces some fireworks headed into the close. The fact that you also have this special rebalance on top of it, it could tick up volatility even further, of course, as money managers try to navigate that, try to bring their portfolios really in line with the new benchmark.
Several risk events for the Nasdaq, including the earnings as well. Mandeep, next week, Alphabet and Microsoft on Tuesday, Meta on Wednesday, Amazon on Thursday. The week after that is Apple. For you and the team, Mandeep, which names are you focused on more than others?
I think right now the focus is definitely on the internet names, and notably Alphabet. Given, we have had a great run for all the other mega caps, Alphabet so far has somewhat missed out, and the ChatGPT overhang, you can see that on the stock. Based on the work that we have done, we've seen, YouTube trends are holding up very nicely. In fact, we think YouTube has taken share in terms of time spent on streaming platforms from the likes of Netflix. And cloud, look, I think you're going to see a benefit accrue to all the cloud vendors from AI, because there is that insatiable demand. And so I think both Microsoft and Google and Amazon are going to call out AI demand on their clouds.
Mandeep, yesterday we were drowning in news from Netflix, drowning in news from Tesla. There were some headlines around TSMC that hardly got any coverage whatsoever. I actually got a couple of messages about it over to Bloomberg. Mandeep, what was important about what happened with TSMC yesterday?
Yeah, so they called out their AI revenue, which is 6% of their overall revenue, but they expect 50% CAGR over the next 5 years. So I think, to put it in perspective, yes, the traditional CPUs and your traditional PC chips are still seeing weak demand. But when it comes to this new pocket of growth, even they call that out. So I think for a vendor like Apple, that may not sound very good, because obviously they are more exposed to smartphones, and that didn't seem to be that good for this quarter. But I do think for AI, I mean, NVIDIA and the likes, this is pointing to the demand, and this is going to hold.
Interesting. Mandeep, thank you. We'll catch up with you next week. Katie, thanks to you as well. The broader market fading a little bit here. 22 minutes into the session. We're still positive, but only just by 0.1% on the S&P 500. Let's lift the lid on this index and get you some sector price action. Here's Abby.
Well, John, let's take a look at the sectors here for the S&P 500. And we are going to see that on the day, earlier to your point, we did have broader gains. But similar to yesterday, we have some strength here from a composition standpoint, more sectors higher than not. That said, utilities, that's a defensive sector. That's the best sector on the day, so perhaps not the most bullish sign. But right below it, tech, and then on bottom, we have materials, financials, industrials, and energy. Interestingly enough, a couple of those sectors are actually the top sectors on the week. If we take a look at what's happening on the week for the S&P 500, we will see the energy up from sort of a stealth perspective, up 2.6%. Financials up 2.7%, as most of those big banks have reported, and many of the regionals. And then finally, consumer discretionary. Well, that has everything to do, of course, with Netflix and Tesla yesterday, and communication services, similar deal.
Abby, thank you. Your trading diary up next. "25 minutes into the session this Friday morning. Good morning to you. Approaching 26. We're positive here by 0.2% on the S&P. On the Nasdaq, bouncing back from the biggest one-day loss since February. We're higher by 0.4%. That's the price action. Here's the trading diary. Coming up, going into the weekend and beyond. US PMIs and the Nasdaq's rebalancing taking effect on Monday. We get earnings from Alphabet and Microsoft on Tuesday. Meta results coming on Wednesday. Plus, we get a Fed rate decision and Chairman Powell news conference too. Full coverage, of course, here on Bloomberg TV and radio. An ECB rate decision coming up on Thursday, US GDP and Amazon earnings as well. And finally, rounding out the week with a BOJ rate decision and Exxon earnings on Friday from New York. That is it for me going into the weekend. Have a great one. Enjoy the rest of the trading day if you can. This was the countdown to the open. This is Bloomberg.